Good morning. I want to welcome members of the public to this open meeting of the U.S. Securities and Exchange Commission. Today, the SEC is considering whether to approve a final standard regarding the quality control systems of audit firms. This standard is sent up to us by the Public Company Accounting Oversight Board for our review. I am pleased to approve this standard because it will improve the quality control systems of auditors, and I think thus better protect the investing public. You see, without high quality audits, investors won't receive complete and truthful financial disclosures. And without strong quality control systems at the auditors can't consistently conduct high quality audits. Nearly 70 years after the stock market crash in 1929, our financial system was once again breaking down, and fraud in financial reporting and accounting eventually led to historic bankruptcies, WorldCom, Enron, and many others. Congress responded by passing something called the Sarbanes-Oxley Act in 2002, and Congress's vision led to reforms establishing that entity, the Public Company Accounting Oversight Board I mentioned, as an independent watchdog over the auditors of public companies and registered broker-dealers. Prior to that, auditing standards had been set by the American Institute of Certified Public Accountants, a professional association amongst accountants. The profession was writing its own rules in essence, and therein lies an inherent conflict. To correct course, Congress set up the PCAOB and tasked it with setting enhanced auditing standards, and the expectation was that the board would produce a more appropriate set of standards going forward. The existing PCAOB quality control standards, however, are still those that were carried over from the professional association. They were carried over 22 years ago on an interim basis. Now, the auditing profession has changed an awful lot in the 21st century, but these current quality control standards are actually from prior to that. And the amendments we are considering today are long overdue. To put in context how important it is to update the quality control standards, the PCAOB found that 46%, nearly half of the auditing engagements it reviewed in 2023 fell short of obtaining sufficient appropriate audit evidence. An auditing firm is ultimately a professional services firm, and it needs to ensure the quality of the services it provides. Those who rely on an auditor's professional opinion must be able to trust the opinion. That trust, though, is based on the assumption that the firm has strong quality control. Whether you're buying a service, you're buying a physical good, you want the manufacturer or the provider of that service or good to actually focus on the quality of its services or goods. So it's important for auditors that the firms have in place something to ensure for quality. Today's proposed standard achieves that goal in 4 ways. You'll hear more about that from our Office of Chief Accountant. The first part is proposed standard requires firms to proactively identify and manage risk within their quality control systems. Second, the proposed standard reinforces the risk-based requirements by requiring ongoing monitor and remediation, kind of driving continuous improvement. Third, the standard holds the firm's leadership accountable in the event of quality control shortfalls. And finally, the standard has varying requirements that differ based on the size and nature of the auditing practice. In essence, there's not a one-size-fits-all. For instance, while all firms have to design a quality control system, only those performing engagements under the standards are required to implement and operate the quality control system. Thirdly, firms that have larger in size, the sort of top dozen or 13 or so firms, those that audit more than 100 issuers are required to have one or more independent persons evaluate the firm's significant judgments and conclusions on the effectiveness of the quality control system. I think 22 years after the passage of Sarbanes-Oxley, after those bankruptcies I referenced about Enron and WorldCom and so forth, I'm proud to support the PCAOB's proposed changes to instill greater trust among investors and issuers in the markets. I'd like to thank the staff and board members of the PCAOB for their diligent work. I also would like to thank the staff of the Office of the Chief Accountant, the Office of General Counsel, Division of Economic Risk Analysis. You can look to our website, sec.gov, for a full list of individuals. But I do want to just take a moment and lastly thank Barb Roper. Barb is somebody who's contributed to the practice of auditing spanning decades. When she was not at the SEC, some 20 plus years ago, she actually was offering advice to Senator Sarbanes and writing Sarbanes-Oxley. And we're fortunate enough that she joined the SEC a few years ago in the chair's office, and she's been working these issues as well and helping all of us. I'll now turn it over to Paul Munter, Chief Accountant, to discuss the rulemaking recommendations. After Paul and Keith Hooper will give their statements, we'll turn it to commissioners for their statements and comments.
Thank you, Chair Gensler, and good morning, Commissioners. It is a pleasure to be here with you today and to be joined by my colleague Keith Hooper from the Office of the Chief Accountant. Keith and I will present the staff's recommendation that the Commission approve a proposal by the PCAOB to adopt a new quality control standard, together with other related amendments to PCAOB standards, rules, and forms, which I'll refer to collectively as QC 1000. In a public accounting firm, an effective QC system provides critical investor protections by driving continuous improvement in the firm's audit quality in support of the issuance of informative, accurate, and independent audit reports. The PCAOB's current QC standards were, as Chair Gensler noted, adopted on an interim transitional basis in 2003 from standards that were last updated by the AICPA in 1997, which was before the accounting fraud scandals of the early 2000s that led to the creation of the PCAOB pursuant to the Sarbanes-Oxley Act of 2002. Further, those QC standards were developed in an era when public company auditing practice was self-regulated under a peer review regime rather than being subject to inspection and oversight by an independent audit regulator. In addition to being outdated and eclipsed by both international and domestic private company QC standards, the PCAOB's current QC standards fall short of the needs of investors in 4 key ways. First, they focus on evaluating compliance with the firm's own policies and procedures rather than evaluating whether the firm's policies and procedures are effective in achieving common QC objectives for all registered firms. Second, the current standards do not require an evaluation of the QC system, nor any reporting of the firm's QC system. Third, the board's outdated QC standards do not have defined individual responsibilities in the QC system. And fourth, those outdated QC standards do not require firms to perform any specific QC monitoring or include any requirements around remediation or root cause assessments. Stakeholders, including audit firms, investors, and others, agreed in their feedback at all stages of this standard-setting project, from the concept release through adoption, that the current QC standards for public company audits require an overhaul. While the PCAOB inspection findings are not the only measure of audit quality, it is nevertheless worth noting that in 2023, as Chair Gensler noted, the aggregate deficiency rates of registered accounting firms continued to increase for both the firms inspected annually and those inspected on a triannual basis. 46% of the issuer engagements inspected by the board in 2023 had at least one Part 1A deficiency. A Part 1A deficiency is of such significance that the PCAOB believes the accounting firm, at the time it issued its audit report, had not obtained sufficient appropriate audit evidence to support its opinion on the issuer's financial statements, its internal control over financial reporting, or both. These PCAOB inspection results should be a wake-up call for all registered public accounting firms including firms that have expressed concern with certain aspects of the board's QC proposal. And in fact, it appears that the QC systems of many accounting firms, including some of the largest firms, are falling short in consistently delivering high quality audits. In response, over the course of 5 years between the PCAOB's concept release and the adoption of QC 1000, the PCAOB has developed an integrated QC standard that strikes an appropriate balance between specific mandates to enhance the effectiveness and rigor of a firm's QC system, while providing appropriate scalability to allow firms to tailor their QC systems to the specific risk associated with that firm's practice and organizational structure. In this regard, certain QC 1000 requirements apply only to firms that issue audit reports for more than 100 issuers annually. In other words, only the largest audit firms, which today amounts to 13 out of the roughly 1,600 registered firms. QC 1000 also addresses developments in audit practice over the period of 30 years and leverages what the PCAOB has learned through 2 decades of experience in inspections and enforcement programs. This includes, for example, the increasing participation of other firms and outside resources in firm engagements, the role of global and domestic firm networks, and the increasing use of technology in public company audits. In developing QC 1000, the PCAOB considered information obtained from its inspection and enforcement activities, other communications with audit firms, the public comments received on the PCAOB's 2019 concept release and 2022 proposal, as well as input from the PCAOB's advisory groups. The PCAOB also considered actions taken by other standard setters, both domestically and internationally. Now, there are 2 aspects of QC 1000 that I would like to highlight today. First, QC 1000 requires all PCAOB registered public accounting firms to design a compliant QC system. However, only registered firms that have obligations with respect to engagements under PCAOB standards are required to implement and operate that QC system. This important requirement allows for timely implementation and operation of a compliant QC system once firms are subject to the requirements to operate such a system under QC 1000, which includes accepting engagements. Allowing firms to design their QC system only after entering into an audit engagement would risk firms being unprepared to accept and perform such an engagement in compliance with all applicable professional and legal requirements. Second, QC 1000 requires the limited number of firms subject to annual inspection to incorporate an independent perspective into their QC system called an External Quality Control Function, or EQCF. The EQCF would be responsible for evaluating the significant judgments made and the related conclusions reached by the firm when evaluating and reporting on the effectiveness of its QC system. Incorporating independent oversight into a firm's QC system has been contemplated by the PCAOB since at least its 2019 concept release, and is the product of significant outreach and stakeholder feedback, including commenters' requests for specificity regarding the function and scope of the responsibilities such an independent QC role would entail. The EQCF requirement provides firms with flexibility to structure the role and design procedures that work best for their culture, governance, and circumstances. In the Commission's Office of the Chief Accountant, we have observed firsthand the benefits of independence to corporate governance structures such as independent audit committees. And many accounting firms appear to have already internalized this lesson, as many of the largest registered firms have forms of independent members in their governance and/or audit quality functions. OCA and other Commission staff have reviewed QC 1000, the comment letters provided both to the board and to the Commission, and other information submitted by the board. Based on this thorough review of the proposed standard today, we recommend that the Commission approve QC 1000. In just a minute, I will invite Keith to provide more details on QC 1000. But before doing so, I want to recognize many of the people who've made significant contributions in developing this recommendation, including from the Office of the General Counsel, Megan Barbero, Bryant Morris, Peggy Kim, Dominica Freda, Eduardo Alamon, Rachel McKenzie, and David Russo. From the Division of Economic and Risk Analysis, Jessica Wachter, Oliver Richard, Lauren Moore, Charles Woodworth, Lyndon Orton, Meijing Zhao, Rebecca Orban, Vladimir Ivanov, Mikhail Pesner, Michael Pessin, and Jill Henderson. And from our office, the Office of the Chief Accountant, Natasha Guinan, Anita Dowd, Shaz Niazi, Keith Hooper, Aaron Nelson, Mikoy Winton, Taylor Pross, John Riggs, Shauna Wolfson, as well as a number of other colleagues from the divisions of enforcement, investment management, corporation finance, and trading and market, and the Office of Secretary. Lastly, I would also like to especially thank the board at the PCOB, as well as the staff of the PCOB for their work on this standard. Now let me hand over to Keith.
Thank you, Paul, and good morning, Chair Gensler and commissioners. This morning, I will provide you with an overview of the significant aspects of QC 1000, including its history. In December 19, the board issued its concept release relating to quality control and received 36 comment letters. In November of 2022, the board issued its QC 1000 proposal and received 42 comment letters, all of which have been considered by the board. In May of 2024, the board approved QC 1000 and filed the proposed rule changes with the Commission for approval. In June, the Commission published a related notice to solicit comments. The Commission received more than 20 letters in response to this notice, including a letter from the PCAOB responding to comments that the Commission received. In making our recommendation today, the Commission staff considered all of the information submitted by the board, as well as the public feedback received by the Commission. I would like to start by briefly describing the basic structure and objective of a QC system designed under QC 1000. This system consists of components that are designed to be highly integrated, from its governance and leadership to the acceptance and performance of its engagements, all the way through the monitoring, evaluation, and reporting of the effectiveness of its system. Under QC 1000, an effective QC system provides reasonable assurance that the firm, each member of its personnel, and each other participant in the firm's QC system or in the performance of its engagements conduct each of the firm's engagements and fulfill their other QC responsibilities in accordance with applicable professional and legal requirements, and that the firm issues each engagement report in accordance with applicable professional and legal requirements. Paul referred to the board's proposal as an integrated QC standard. QC 1000's risk assessment and monitoring and remediation components contain significant enhancements over current PCAOB QC standards, and they drive the integrated nature of the QC system. Rather than only focusing on compliance with a firm's existing policies and procedures, the new risk assessment component requires firms on an annual basis to assess the risks of not meeting the objectives of the QC system, and additionally, to identify and assess new and evolving risks throughout the year with an explicit requirement to consider information from its monitoring and remediation component. The firm is required to design and implement effective responses to these assessed risks, and this creates a feedback loop, driving continuous improvement of the QC system with a view to correcting current deficiencies and preventing future deficiencies. Among other new requirements, the monitoring and remediation process requires firms to monitor both engagement level and QC level activities, include a root cause analysis in their process, and requires all firms to monitor completed engagements and specifies the expected frequency of this monitoring. In addition to monitoring completed engagements, the largest firms are also required to monitor in-process engagements. QC 1000 emphasizes the importance of accountability and firm governance by placing requirements across its integrated components that emphasize individual responsibility. I will now highlight 4 new requirements driving that accountability and governance. First, QC 1000 requires individuals at the firm to be assigned to specified roles and responsibilities within the QC system. In addition to the EQCF role that Paul discussed, other firm responsibilities include the requirement for the firm's principal executive officer, commonly the CEO, to be ultimately responsible and accountable for the QC system. There are also required roles for individuals to maintain operational responsibility for the QC system as a whole, compliance with ethics and independence requirements, and the monitoring and remediation process. To add accountability and rigor to the evaluation of the QC system, QC 1000 requires annual certifications by both the principal executive officer and the individual with operational responsibility of the QC system. Additionally, QC 1000 contains quality objectives that emphasize the importance of tone at the top, including appropriate incentives for firm leadership. Second, the ethics and independence component requires firms to obtain a certification from its professionals regarding their familiarity and compliance with the firm's independence and ethics policies. This will enhance individual accountability across the firm and ultimately compliance. Additionally, the largest firms are required to have an automated process to track firm and personal investments in securities that may impair auditor independence. Third, the governance and leadership component requires firms to have a process for receiving, investigating, and addressing complaints and allegations that must include individual protections from retaliation, with incremental requirements for the largest firms that their process allow for confidential and anonymous submission, such as through a whistleblower hotline. The last item driving accountability I would like to highlight relates to the evaluation and reporting on the QC system. QC 1000 requires firms to evaluate the effectiveness of their QC system on an annual basis as of September 30th and report to the PCAOB on a new non-public Form QC by November 30th. When performing this annual evaluation, in addition to the principles-based requirements for evaluating and responding to information that indicates there may be deficiencies in the QC system, QC 1000 specifies circumstances in which a major QC deficiency is presumed to exist. An unremediated major QC deficiency results in an evaluation of an ineffective QC system. These aspects of the annual evaluation should drive consistency and comparability across firms' evaluations. The reporting to the PCAOB includes, among other things, the certifications that I mentioned earlier, descriptions of any unremediated deficiencies, and a summary of remedial actions taken. Under SOX, the Commission is required to make a determination that it is necessary or appropriate in the public interest after considering the protection of investors and whether the action will promote efficiency, competition, and capital formation to apply QC 1000 to the audits of emerging growth companies, or EGCs. As discussed more fully in the draft approval order, we believe that applying QC 1000 to the audits of EGCs meets this standard. Furthermore, there are potential practical difficulties when not applying QC 1000 to the audits of EGCs because many elements of quality control are necessarily firm-wide and cannot be easily differentiated for different types of audits, such as many of the integrated components that I just highlighted. Even where such differentiation may be possible, maintaining separate components and systems for EGC and non-EGC audits may add cost, lead to confusion, and could run counter to the objective of integrating QC practices into a continuous cycle of risk assessment, monitoring, and remediation to drive higher quality audits. Additionally, the benefits of applying QC 1000 may be especially pertinent to the audits of EGCs in that QC 1000 is expected to promote higher audit quality and thus improve the reliability of EGC financial reporting. This would, in turn, enhance investor protection and lead to an improved efficiency of capital allocation and enhanced capital formation with respect to EGCs. We have reviewed and considered QC 1000, the information submitted by the PCAOB, and the comments received by the Commission. Based on that review and for the reasons set forth in greater detail in the draft order, we recommend that the Commission approve QC 1000 on the basis that it is consistent with the requirements of Title I of SOX and is necessary or appropriate in the public interest or for the protection of investors. Furthermore, as I just mentioned, we recommend that the Commission find that the application of QC 1000 to the audits of EGCs is necessary or appropriate in the public interest after considering the protection of investors and whether the action will promote efficiency, competition, and capital formation. In closing, I would like to echo the thanks that Paul already gave for my many colleagues' support throughout this project, and I will now turn it back to you, Chair Gensler.
Thank you, Keith. Thank you, Paul. Commissioner Peirce.
Thank you, Mr. Chair. Thanks, Keith. Thanks, Paul, for your presentations and for your work on this standard. Auditors play a critical role in maintaining healthy capital markets. Comprehensive, dynamic quality control systems help audit firms fulfill their mission. As you've heard, there were troubling high audit deficiency rates, and though they're likely attributable to multiple causes, they do suggest that the 5-year-long effort by the Public Company Accounting Oversight Board to revamp its outdated quality control standards was warranted. Getting the quality control standard right, however, would have required more time for additional pointed questions, comment, reflection, and revision. The PCAOB now, with the Commission's assent, has cut the process short and put out QC 1000, a standard that still needs work. Accordingly, I'm unable to support it. Ironically, with respect to a standard that focuses on quality control, the Commission has failed to perform its external quality control function, one that Congress entrusted to us. Congress established the PCAOB, a nonprofit corporation, to oversee the audit of public companies that are subject to the securities laws and related matters in order to protect the interests of investors and further the public interest in the preparation of informative, accurate, and independent audit reports. Congress directed the PCAOB to establish audit standards, including quality control standards. For these standards to become effective, Congress required Commission approval under the same process that we use in considering whether to approve self-regulatory organization rules. That process affords the Commission the discretion to institute proceedings to consider whether to approve a rule. Because one board member dissented and numerous commenters expressed serious concerns with the PCAOB's final standard, we should have instituted proceedings to afford us, the PCAOB, and the public more time to think about this standard. Instead, wishing away any difficulties, we're rushing an approval order out the door. The standard will pose many significant implementation challenges, but several concerns particularly stand out. First, even though many registered firms do not perform audits of issuers or broker-dealers, all registered firms must design a quality control system that complies with QC 1000. Firms, as part of the current registration process, file a quality control statement, but the comprehensive and prescriptive QC 1000 requires much more, which is the basis for concerns about the design-only requirement, which requires firms, regardless of whether they will use them, to design quality control systems. For the up to 60% of registered firms that are not performing issuer or broker-dealer audits, designing a quality control system that satisfies QC 1000 will be difficult, costly, and pointless. Difficult because a firm that is not auditing issuers or broker-dealers or planning to do so in the near term will be designing a hypothetical system. Costly because QC 1000 is more rigorous and prescriptive than other quality control standards that these firms might be using. And pointless because QC 1000's design exercise is tailored specifically for audits of issuers and broker-dealers, meaning it's hypothetical and of little benefit to investors for firms not doing that work. Even a firm that might want to take on issuer or broker-dealer audits eventually might want to wait to design a quality control system closer to the time it begins considering whether to take on engagements, since a generic quality control system may, despite that firm's best effort, be inapt for the task at hand. Neither the Commission nor the PCAOB is bothered by the likelihood that firms may deregister rather than comply with the design requirement in QC 1000. The Commission and the PCAOB both wave away questions about whether the board has legal authority to adopt a design-only requirement that applies to firms that do not perform audits of issuers or broker-dealers. Second, despite the board's frequent emphasis that QC 1000 strikes the right balance between prescription and principles-based obligations and that its expectations are clear, the standard leaves lots of room for second-guessing through inspections and enforcement. The standard has many prescriptive elements that are not risk-based, such as requiring all identified engagement deficiencies to be remediated. Throughout the proposing release, the board suggests that prescribed elements will satisfy QC 1000 expectations, only to add an immediate however that pulls the props out from under this clarity. The board's pithy description of the fluid nature of the quality objective selection process, the standard sets forth a floor rather than a ceiling, could be applied to just about every aspect of the standard. A firm's quality control system should be tailored to its unique risks and circumstances, but as written, the standard will pose many implementation challenges and perhaps scare people away from taking leadership roles because the scope of their liability under such a far-reaching and ambiguous standard is unclear. Third, the board did not take adequate account of how QC 1000 will interact with other quality control standards from other standard setters. Firms might have to maintain multiple quality control systems or juggle inconsistencies across the different standards. A firm's quality control system, for example, might be effective under another quality control standard, but not under QC 1000. To address competitive concerns, the board could have allowed small firms to design and operate their quality control systems under either QC 1000 or one of those other standards. As one commenter explained, implementing yet an additional, or in many cases a third new standard intending to address the same objectives will distract limited firm resources away from continuous audit quality improvement and could cause firms to spend more time differentiating between and ensuring compliance over the multiple standards across multiple jurisdictions. In a bit of having one's regulatory cake and eating it too, while the board deems these other QC standards insufficiently similar in coverage and prescription to allow them to substitute for QC 1000, the similarities are more than sufficient when calculating implementation costs and even compliance dates. Fourth, because the requirement that firms audit more than 100 issuers established an external quality control function that differed materially from what was proposed, many questions remain unanswered. The responsibilities of the EQCF must include, at a minimum, evaluating the significant judgments made and the related conclusions reached by the firm when evaluating and reporting on the effectiveness of its QC system. What does this role entail in practice? What procedures must the EQCF follow to reach and document its review? When must that review take place? What if its judgments differ from the firm's judgments? Does this role's specificity, which differs from the proposal, require some or all large firms to set up a new audit quality oversight function? Or are the functions they already have in place sufficient? If this function is new, who would be likely to perform such a function? What type of liability might the EQCF face? Does the answer differ depending on whether the person is an auditor? Does the EQCF requirement broaden the PCAOB's reach to parties over which it has no legal jurisdiction? Will EQCFs be subject to firm discipline? Will the firms have to share confidential information with the EQCF? And what are the legal implications of doing so? Given the likely expense of the requirement as adopted, should the threshold for application of the requirement be higher, perhaps applying only to firms that audit more than 500 issuers, as some commenters suggested? The PCAOB submitted a lengthy comment letter to the file, which attempted to address some of these questions, but the post-standard commentary of the board is not the way to address fundamental questions about a role that was first fleshed out in the board's adopting release. As I noted at the start, quality control is important, and I'm glad that the PCAOB is focused on it. Much of the board's work is good, and the PCAOB staff dedicated commendable effort to this critical initiative. But the standard is not ready for prime time. We need more public input, which would have required the board to repropose or us to take the step of instituting proceedings. I appreciate all the work that the staff at the Commission has done over the past several months. A lot of midnight oil has been burned. Thank you especially to the staff in the offices of Chief Accountant and General Counsel and the Division of Economic and Risk Analysis. I do have a number of questions. First question is for the Office of General Counsel. The Commission's order describes the statements in the PCAOB response letter that it put in August 2024 as being on par with statements made by the board in the adopting release about the scope and application of the QC 1000 requirements. Are the statements in that letter binding on the PCAOB? Are they binding on PCAOB registered firms? And if the statements in the letter conflict with the PCAOB's adopting release, which one controls?
Thank you, Commissioner. To the extent the comment letter addresses and provides additional clarity on the proposed rule change, we view any such statements by the board in its comment letter as guidance from the PCAOB. Firms may find that guidance helpful in seeking to comply with the rule, but ultimately they will need to follow the PCAOB rule, which sets forth the requirements for QC systems. The PCAOB may issue additional guidance in the future if it believes that would be helpful for firms. But again, firms must follow the requirements set forth in the rule, and the guidance or the comment letter cannot change those requirements. In terms of conflicts, we're not aware of any conflicts between the statements in the letter and the adopting release. But I would just reiterate again, it's the rule itself that must be followed. And so it's the rule that would control the firm's obligations with respect to the QC systems.
So it sounds like the adopting release of the PCAOB has, we often cite, for example, in enforcement actions, we'll cite a statement that's made in one of our adopting releases that goes along with the rule text. What you're saying is not ignore, but the guidance might be there in the adopting release, but what really matters is what's in the language of the standard. Is that right?
Well, I think it is, as I said, and I think it's as our order makes clear, we are viewing the comment letter as providing additional clarity, essentially as guidance from the board. But to the extent your question went toward conflicts between the guidance or the letter and the rule, it is the rule that controls.
Okay, thanks. The process has been a bit frustrating for me, at least, because the letter adds some new information, which it's difficult to reconcile with the adopting release. So it's been a bit frustrating. This question is probably for OCA. Is requiring audit firms that don't audit issuers or broker dealers to design quality control systems that comply with the new standards a backdoor way of expanding the PCAOB's jurisdiction?
Thank you, Commissioner. No, the PCAOB under Sarbanes-Oxley is already required to require firms that register with the PCAOB to have QC policies in place. That is a provision in SOX, and it is incorporated into their registration process today for all firms that choose to register with the PCAOB.
Yeah, so I know that firms make a statement about their quality control systems, but I think when you look at the statute, and I think this is an area where maybe we disagree, but when you look at the statute, there does seem to be a link to quality control standards back to engagements that are actually covered by the statute, which now is issuer audits and broker dealer audits. And so I think, as Keith was discussing with EGCs, it would be really hard to say, okay, you have a quality control system, but it doesn't have to apply to EGC audits because it sort of applies to what the whole firm does. And so it seems to me by saying, yeah, you have to design a quality control system, even if you're not doing PCAOB audits, we're effectively saying you have to do all of your audits in accordance with this quality control system. And that seems a bit problematic to me. It seems like a bit of a reach for the PCAOB.
The requirements are to design a QC system. It is not a requirement for firms who are not doing PCAOB audits to execute an audit in accordance with QC 1000.
Yeah, no, I understand that. I mean, I understand that it's a design only limitation, but I think what you're going to end up with is firms spending the time to design a quality control system, not wanting to have two systems in place. And so effectively, PCAOB has expanded its jurisdiction. And I think that is a concern just because it could be quite costly for those firms, and they're just serving a different market. So I do have some concerns about that. Has the staff thought about how that design only requirement will affect the auditors. So often in our rules, will require that an auditor be PCAOB registered, even if the PCAOB doesn't oversee those kind of auditors. I'm thinking about the auditors that have to do the custody audits for investment advisors. Has the staff thought about how that design-only requirement will affect that group of auditors?
Commissioner, we have, and the order speaks to that and acknowledges that, as you rightly say, because commission rules require certain circumstances where a registered firm must perform certain audits, such as custody audits, as you described. So the order does acknowledge that there will be firms in that category that may be subject to additional costs to design a QC 1000 compliance system.
Yeah, I mean, that's certainly a concern for me. So when I look at the number of firms that are going to be design only, it seems to be probably around 51 to 60%, I think, based on how many firms have audited broker dealers or issuers in the last 1 to 5 years. So what is the PCAOB thinking in terms of enforcement of this standard, both for those firms that are not performing broker dealer or issuer audits, and then more generally for all firms?
Well, for all firms, let me parse that apart. Firms that are performing either issuer audits or broker dealer audits would be subject to inspection regime and obviously potential enforcement related to that when there are issues involved. For those that are not performing either PCAOB audit or the audits of registered broker dealers, they have not historically been subject to inspection by the PCAOB. In terms of what specific plans the board has, I'm not aware of any, but I would acknowledge that the PCAOB has a rulemaking underway that is re-examining the firm registration requirements.
Okay, but I guess so is typically the inspections are tied to specific audit engagements. And so is that how, with respect to firms that are doing issuer and broker dealer audits, they will look at the quality control system in conjunction with particular engagements, or might it be something different?
No, it would be in conjunction with the inspection program, whether it's an annually inspected or a triannually inspected. When the PCAOB inspects a firm, as you rightly note, Commissioner, they do inspect specific engagements, but they also do an evaluation of the firm's quality control system.
Okay, and then with respect to form, I think it's called Form QC, the new form. Is that form protected by confidentiality protections, the information protected on that form? And if not, do we have any concerns about that information getting out into the public?
Thank you, Commissioner. I can take this one. As discussed in the approval orders, certain information contained within a Form QC may be subject to the confidentiality protections of SOX, and it's Section 105B5A, which addresses documents and information prepared or received by or for the board in connection with an inspection or investigation. But in addition, in some circumstances, remedial actions reported in Form QC may be subject to laws relating to the confidentiality of proprietary, personal, or other information. And in such a scenario, the board, in accordance with SOX Section 102E, would need to honor a firm's properly substantiated request for confidential treatment of such information. And I'd also note the board also adopted Rule 2203 Cap AC, which provides that Form QC will be non-public in light of the confidentiality provision that applies to quality control criticisms and potential defects identified during a PCAOB inspection in SOX 104 G2. So to the extent that the specific information contained within a Form QC meets the requirements of these confidentiality protections, those protections should still apply to the information to the same extent as other information that would be submitted to the board.
Okay, well, I certainly hope this is an area that we'll keep an eye on, just because this information will not be submitted in connection with an inspection necessarily, and so that's a concern for me. Um, Another concern, which is really quite a concern, given that we had a bad experience with Sarbanes-Oxley 404 and the expense of implementing that, it was quite a difficult process for firms, for their clients, and ultimately the PCAOB ended up having to put out a new standard. So some commenters look back to SOX 404 implementation and they say, this might happen again. Section 404 is similar to QC 1000 in that Section 404 was a policy shock that led large public companies to improve their internal control practices. In addition, while QC 1000 is not an internal control framework per se, it does reflect similar principles as COSO, the industry standard control framework that was widely relied upon to implement Section 404. That's a quote from the PCAOB's adopting release. So should we expect the same kinds of problems and expenses for auditors and issuers that we saw with the introduction of SOX 404? And if so, what is the board doing to mitigate those potential costs?
Well, Commissioner, I appreciate that some commenters drew an analogy to 404. I do think there's a framework that we need to think about as we're thinking about the cost of implementing QC 1000. While there's been a number of studies that looked at the cost of implementing 404, there was actually a very significant commingling effect that, to the best of my knowledge, has never been parsed apart. As Chair Gensler was describing, 404 was implemented in an environment where there have been widespread failures of financial reporting, widespread ineffectiveness of internal controls, and some significant audit failure. And so there's a question in terms of 404, how much of that is incremental to adopt 404 versus how much of it is to bring financial reporting and internal control processes up to the standards that were already required and expected. And so I think that's a really important analogy, because QC 1000 leverages the requirements of ISQM1, that's the international standard, and SQMS1, which is the domestic standard that will take effect at the same point in time. And therefore, to the extent that a firm has or will be rigorously and comprehensively implementing one or both of those other QC frameworks, then the incremental requirements of QC 1000 will be relatively minor.
Yeah, I mean, I'm not sure I agree with you on your analysis of the 404 experience, because I think everyone at the time, well, a lot of people at the time recognized that a lot of the work that auditors were doing in order to comply with the initial standard AS2 was busy work essentially, and was unnecessary work. And so that was why the standard was revised, so that auditors and issuers could be focused on what really mattered. And so I'm just worried about a similar thing happening here. And then with respect to your point about there being other quality control standards that are going into effect, I think the problem is that the PCAOB has been really unclear, right? On the one hand, they've said those other standards are going to be really helpful, and the incremental cost will be small. But on the other hand, they've said, but we can't let small firms, for example, just rely on those other standards because the differences are so big. And so I think this is an area where we're going to have to watch very closely to make sure that the PCAOB is giving good implementation guidance, and that audit firms are behaving. They're not engaging in protective activity that is actually trying to protect them from liability, rather than trying to set up really good quality control systems, which is what we all really want. And I think as we all would agree, we want to get the balance right. And so I think our role is going to be important. The PCAOB's role is going to be important in this upcoming implementation process. I did wonder why. So the commission's order says 77% of the firms registered with PCAOB are unlikely to incur significant incremental costs, but that does leave a pretty high 23% that may incur significant additional costs. Why didn't the PCOB allow these firms additional time? And I guess those are the firms that aren't subject to one of these other standards.
Commissioner, the 77% that's in the order is an estimate based on publicly available information, and so that's likely the minimum. There are of the other 23%, we don't necessarily have data on all of them, so we don't know to what degree firms in that other 23% are subject to one of the other QC frameworks. So that's from what we can tell the maximum number, but it's unclear whether there's something smaller than that involved.
And did the PCOB consider affording those firms, the ones that are really going to be doing this from whole cloth, did they consider giving those firms more time?
The PCOB gave a lot of thought to the effective date throughout the process of its standard setting, and did give that consideration, but concluded a single effective date would be most effective and efficient in driving improvements in audit quality.
Yeah, I mean, again, I think the PCOB could have given a little more consideration to thinking about more time for different categories of firms, small firms, design only firms, and so forth. I guess my next question is for Dira. So the PCOB does acknowledge that the standard could cause firms to exit, raise costs for audit clients, deter mergers and acquisitions, exacerbate the talent crisis in the audit profession, but it always finds a silver lining in each of those clouds. The board's reasoning, though, in finding those silver linings sometimes seems a bit strange. So here's one example. The board explains that with respect to the increased demand on firm personnel, to meet increased demand for staff resources, some firms may choose to hire additional experienced staff. It's possible that the labor demand shock could result in increased wages and potentially higher audit fees, which could be exacerbated by the concentration of large firms in the audit market. Higher wages could in turn help firms attract and retain a skilled workforce or encourage qualified individuals to take essential roles at firms. So for Dira, how plausible is that scenario?
Thanks for directing a question at Dira, Commissioner. So we do find that scenario to be plausible. I think what the board is highlighting here is a quantity response to a demand shock. So there may be a price response. So if this is a demand shock for auditing services, then the price would go up, but that would also, with time, attract more quantity. So in this case, potentially more people entering the auditing profession. Now, I'll say that whole discussion is cabined within the question of how large is that shock. And as we've been discussing, that's really a question of the number of firms and that are going to be implementing incrementally parts of QC 1000 compared to what they would be doing anyway, and how large those additional pieces are.
Well, again, I'm having flashbacks to 404 when I talked to a lot of public companies that were extremely distressed by the increases that they were facing in terms of the costs that were being passed on to them by their audit firms. So I hope we'll keep an eye on that. Why does and I think, Jessica, you're off the hook now. I think this is back to Paul. Why does the standard set a fixed annual evaluation date of September 30th? Why not, as one commenter suggested, allow firms to select their own date, one that might, for example, align their quality control period with their fiscal year end to emphasize the role of quality in a partner's performance and compensation?
The PCOB is striving for both consistency and comparability. And by having a fixed date, it will allow an evaluation of QC systems for all firms at a same point of time, thereby providing for much greater comparability. Additionally, the PCAOB is also working to be able to accelerate their inspection cycle, and having a fixed date that is a little bit earlier in the year will facilitate that process as well.
So does that mean that they're not going to be straddling? Because I know now some firms on September 30th are kind of in the middle of remediating problems. So that means it's going to be shifted forward. So that's not going to happen where it's straddling two inspection cycles.
Well, it would depend. It would depend on when the deficiency is identified, of course. So it would be affected by it, but the remediation of it would be attributed to a specific year in the QC reporting cycle.
Okay, again, I think this is an area where the PCAOB could have afforded more flexibility and it wouldn't have come. I mean, I'm not sure that the comparability that you get from having everyone use the same time period really matters as much as trying to get the firm to line it up with, for example, the way they compensate folks. So again, I hope this is an area that we watch, and maybe it's an area where flexibility could be provided in the future if it's not working. So we talked a little bit about the fact that a lot of firms already are doing a lot with respect to their QC systems, either because they're trying to address the deficiency problems that they have and they're trying to get to a better place, or they're facing these other standards that are coming up. What do you think is the biggest thing that will come out of QC 1000, the biggest positive that will come out of QC 1000?
Well, QC 1000, of course, is designed to drive continuous improvement in audit firms' audit quality. Audit quality is the value proposition the audit profession brings to capital markets. High quality audits give investors more confidence in the quality of the information they are receiving, which of course drives lower cost of capital and facilitates capital formation. And so the benefit to the capital markets, if firms implement QC 1000 in a rigorous manner and do drive continuous improvement to audit quality, are those benefits to the capital markets.
Well, I hope we'll see those benefits. I think we would have seen more if we had given more time for QC 1000. And I think a lot of this is going to depend on how well the PCAOB does in implementing the standard. And that's something that I hope that you will watch closely. I don't have any additional questions. Thank you.
Thank you, Commissioner Peirce. Commissioner Crenshaw.
Good morning. Happy Monday as the Commission kicks off this week with a vote on, as you've heard, amendments to existing quality control standards, or as I'll refer to them, the QC amendments that the PCAOB or the board adopted earlier this year. Quality control systems are embedded throughout our economy and across industry sectors. Consumers rely on quality control systems when they see the results of food and safety inspections posted in restaurant windows, or the USDA ratings affixed to the food you buy at the grocery store. Behind these ratings are processes subject to guidelines and review from regulators to ensure goods and services meet a certain quality standard. And when that basic quality requirements, the floor, is not met, and food is unsafe for consumption, those products are generally kept off the market until the producer or service provider remediates the problem. Just as grocery store shoppers and restaurant diners can be confident that adequate quality control systems are in place to mitigate the risk that their food is unsafe, investors should be confident that audit firms have robust quality control systems in place. These systems are designed to facilitate consistent, reliable, and informative audit reports. The QC amendments that the board adopted provide that floor. The QC amendments require PCAOB registered audit firms to design a quality control system subject to prescribed quality objectives and processes. firms will have flexibility to tailor the design of the required processes to their specific risks and needs. Further, the QC amendments take a scaled approach, as you've heard. All PCAOB registered firms are required to design a quality control system. Thinking through how to ensure basic quality control systems never strikes me as pointless. I'd rather design controls for a fire evacuation and not use it than never plan it at all. And while they must think it through, only those firms that actually perform an audit under PCAOB standards must then operate their quality control system. And of those firms, only a tiny subset, firms that perform over 100 engagements per year, would be subject to the full suite of the QC amendments, including the external quality control function. Finally, the QC amendments require an annual evaluation of the effectiveness of applicable firms' quality controls. The QC amendments, as again you've heard, are the result of years of work, outreach, and development that include robust public engagement with multiple points at which the public weighed in through notice and comment. The standard setting process began in 2019 with a concept release that solicited feedback on many of the key elements contained in today's QC amendments, including whether there should be a person independent from the firm to oversee the quality control system. Using feedback from the concept release, the board issued a proposal in November of 2022, which solicited comments from firms, investors, academics, and others that informed the adopted QC amendments. The 2022 proposal also included a requirement to have an oversight function fulfilled by a person who is independent from the firm. Finally, the Commission received the QC amendments from the board earlier this summer, published them in the Federal Register, and then held our own comment period, which was twice extended. The Commission reviewed and carefully weighed the information submitted to us by the board and all the comments we received. We have considered the statutory authorities for the QC amendments, the rationales developed by the board, the impacts on efficiency and competition in the market for audit services, and, moreover, expanded upon the board's economic analysis with our own. At this point, we have an adequate basis to move forward with a vote on the QC amendments. This has been a robust process and years in the making. It is time for quality control systems in the audit industry to be subject to updated standards and oversight so that investors can rely on a solid foundation. Just as we all rely on quality control systems to ensure that we can go to the grocery store or a restaurant without really worrying whether the food is safe to eat. Thank you to Chair Williams, members of the board, and its staff. It's evident that you have been hard at work to ensure that public financial statement reporting is anchored in strong, meaningful, and independent audits. And of course, I also want to give an enthusiastic thank you to the staff at the Commission, the Office of the Chief Accountant, the Division of Economic and Risk Analysis, the Office of the General Counsel, and all others who worked on this matter. I know that you have put hours upon hours of hard work to help the Commission prepare for today's vote. Thank you for your dedication and your public service. It certainly does not go unnoticed. I'm happy to support.
Thank you, Commissioner Crenshaw. Commissioner Ueda.
Well, thank you, Chair Gensler, and thank you, Paul. Thank you, Keith. I'd also like to give a shout out to the staff here in the Fort Worth Regional Office for their hospitality during my visit and for making my participation in this open Commission meeting possible. Today, the Commission considers whether to approve an updated standard of the PCAOB's governing audit firms' quality control systems. Approving the PCAOB's rules and standards that was similar to other self-regulatory organizations, such as FINRA and the National Securities Exchanges. This process provides for a notice and comment period and gives the Commission 90 days to approve or disapprove the rule. If the Commission needs more time to consider the rule, then it can extend the period for an additional 90 to 150 days. Today is the end of the initial 90-day period for the updated quality control standard. During this period, several commenters raised concerns that the PCAOB had not provided the public with an opportunity to consider the requirement for certain firms to adopt and implement an external quality control function, or EQCF, during its rulemaking process, and that the final requirement was not a logical outgrowth from the board's proposal. On August 16th, 2024, the PCAOB filed a 28-page letter with nearly 19 pages dedicated to the EQCF requirement in an attempt to respond to commenters' concerns. This explanation was significantly more expansive than the PCAOB's quality control standards adopting release, which spent only 5.5 pages on the EQCF requirement. In response to the PCAOB's letter, the Commission received 2 more letters shortly before Labor Day, calling for additional information and guidance. Given the flurry of new feedback, it would have been prudent for the Commission to extend the process to allow for thoughtful consideration of the standard, particularly the EQCF requirement. These comment letters are an important part of the process for considering whether to approve or disapprove the updated quality control standard. This is especially the case when the PCAOB's letter provided additional justifications for the EQCF requirement that were not part of the adoption release. To properly exercise its oversight responsibilities, the Commission should take the time to consider concerns raised by market participants and the PCAOB's responses. Unfortunately, the Commission did not do that. 2 weeks after receiving the PCAOB's August 16th letter, and 1 day after receiving a market participant's letter calling for additional information, the Commission issued the notice for today's meeting, including its intention or indicating its intention not to extend the consideration period beyond the initial 90-day period. The Commission could have used more time to allow more market participants to express their views on the PCAOB's letter and for the PCAOB to provide additional guidance. This could have resulted in a better standard that would benefit the PCAOB, audit firms, audit clients, and most importantly, investors. It is unfortunate that the Commission has not chosen to do so. The decision is puzzling when the Commission has routinely used the extension for rules of FINRA and the National Securities Exchanges upon which the Commission's process for approval of PCAOB standards is based. This decision is puzzling when the Commission has routinely used the extension for rules of FINRA and the National Securities Exchanges upon which the Commission's processes for approval of PCAOB standards is based. In addition, I'm concerned with the standards requirement that every PCAOB registered firm, even those without a current audit engagement, subject to PCAOB standards, must design a compliant quality control system. While the requirement to implement and operate an effective quality control system applies only to firms performing engagement, the standards design-only requirement imposes costs without attendant benefits. This requirement may disproportionately burden smaller audit firms that do not have current engagements, but may be seeking smaller public companies, broker-dealers, and others as clients. Several commenters expressed similar concerns. In dismissing these concerns, the Commission states that without the design-only requirement, there would be a risk that, quote, firms could be unprepared to accept and perform engagements. However, neither the Commission nor the PCAOB has presented data to demonstrate that the firms cannot design, implement, and operate a compliant quality control system upon starting an engagement. In defending the design-only requirement, the Commission demonstrates its paternalism by implying that public companies and broker-dealers engaging an audit firm cannot make their own judgments on the preparedness of a firm, simply because the firm had not designed a quality control system before the engagement. In a competitive market for audit services, firms that are unable to successfully perform engagements will not receive engagements. The PCAOB's rationale is equally unpersuasive. The board states that the design-only requirement is consistent with our investor protection mandate. But if a firm does not have any engagements, exactly which investors are being protected? The PCAOB states that, quote, investors and companies considering engaging the firm could reasonably expect that any firm that could pursue such an engagement would already have a PCAOB compliant quality control system designed and ready for implementation and operation, unquote. However, if investors are adequately protected by having the implementation and operation requirements apply only upon engagement? Why are they not simply similarly protected if the design requirement also applies at that time? The idea that firms that have not designed a quality control system pre-engagement aren't capable of doing so upon engagement is not supported in the record. Fast and Furious might be a good theme for summer movies, but not for agency rulemaking. Let me be very clear here. My concern is not about whether there should be strong quality control requirements. There should be. The question is when. Having quality controls when there are no engagements provides little benefit. Because of the unnecessary costs and paternalistic approach of the updated quality control standards design-only requirement, as well as my concerns with the process, I do not support today's action, which I find arbitrary and capricious. However, I thank the PCOB board members and their staff, as well as the commission staff, especially those in the office of the chief accountant, the office of the general counsel, DERA, and others for their work on the recommendation. I just have a couple questions based on the earlier discussion. Paul, you indicated that in recent years, there has been a significantly high deficiency rate for inspections conducted by the PCB and audit firms. I think you said 46%, is that right?
That's, Commissioner, yes, that's what the PCOB has reported, yes.
Okay. Do you know what the board's explanation for these such high deficiency rates is? Is it their view that we're dealing with a rogue and outlaw industry here, that almost a majority are not in compliance?
Well, the PCOB doesn't generalize. The findings are specific to individual firms, while the percentages obviously are generalizing. But I think there's a number of factors at play, to be candid with you, Commissioner. Without speaking to the specific underlying root cause, I think that is a key issue, that current QC standards don't have a requirement for a root cause assessment. And that's the first step of a firm being able to remediate deficiencies in its audit practice, is doing a rigorous root cause analysis so they can identify what is the cause of the deficiencies and what kinds of remediation efforts they can put in place to drive improvements in audit quality going forward.
All right. Well, I appreciate those thoughts. My own observation is when we receive very, very high rates of noncompliance, it raises questions as whether the regulator has appropriately communicated what are the expected standards of conduct and the duties on those who are being regulated. So, I continue to look at this. I think all of us are concerned about those deficiency rates, but again, in my mind, it raises the question whether or not there's been a failure to communicate what the expected standards of conduct are on behalf of by the regulator. Let me switch to something that Commissioner Peirce put up. Do you think that AS2 was an outstanding success in a model rulemaking for implementation of the internal controls over financial reporting?
Commissioner, AS2 put in place a process that I think has been very successful, in that the standard was developed through notice and comment, and obviously was approved by the commission. But one of the things that the PCOB put in place as part of their process is a post-implementation review. And I think the post-implementation review identified areas where there could be improvements in the standard, which the PCOB implemented subsequently. And I think here the PCOB, consistent with its process, has indicated that it's going to consider whether there's a need for a post-implementation review, and whether coming out of that there might be the need for additional guidance or improvements in this standard.
All right. My recollection was AS5, which replaced AS2, came out only a few years after AS2's adoption. So what will be the types of things that the PCOB should be looking at in a retrospective review to determine whether or not they need to update or amend or replace the current QC standards in the next couple of years?
Well, the next couple of years would actually be only at the point it is just initially being implemented, Commissioner, because it wouldn't be effective until December 15th of 2025. So in the next couple of years, most of their activities would be obviously engaging in dialogue with the firms and understanding what questions firms might have as they are implementing it, and considering the need for any guidance that might help support implementation.
Right. Well, I recognize it's not going to be effective for a few more years, but I would expect that prior to that compliance date, that there will be a fair amount of efforts undertaken by audit firms to apply this new standard, and that there may be a significant number of questions and concerns as a result of that implementation process. Wouldn't you agree?
Well, it depends on the firm's circumstances, what the level of effort would be, Commissioner. But the PCLB's supplemental response letter indicated that they stand ready to provide support as firms begin implementing QC 1000.
Okay, so you're suggesting that some firms would not require any effort whatsoever to, prior to the compliance date, to take efforts to comply with this new standard?
I don't think I said that, Commissioner.
Okay, then can you sort of repeat that? Because I would think that firms would have to start taking measures to make sure that they're in compliance with this new quality control standard.
Yes, the amount of effort they will have to take will depend on what their existing QC system is today, and whether they have implemented or are implementing any other QC frameworks.
All right, yeah, and that's what I would expect too. It may vary from firm to firm. The reason why I bring this up, and what perhaps Commissioner Peirce is too modest to say, is both she and I were on the staff during the time of the adoption of AS5, and we heard a lot of concerns about the way that was being implemented. And I would prefer that we not have a repeat of that experience with the 404 ICFR and AS2, AS5 process. We need high quality standards, but we don't need a lot of perhaps wasted and misdirected effort in achieving that goal. That's it. I do not have any further questions.
Thank you, Commissioner Ueda. Commissioner Lizarga.
Thank you, Chair Gensler. Thank you, my fellow commissioners, and my thanks also to the commission staff for their presentations and their work on the standard. And also like to express my gratitude to the board members of the PCAOB and the staff for their work on this important standard. The Sarbanes-Oxley Act, which created the PCAOB and was enacted unanimously in the U.S. Senate and nearly unanimous in the U.S. House, provided for the establishing and modification of quality control standards. This important law required the board to establish expert advisory boards to make recommendations on QC standards. When registering with the board, auditing firms are required to include a statement on QC policies. And when inspecting audit firms, the board is required to evaluate QC systems. Congress enacted these provisions in 2002 to address accounting fraud and systemic misconduct in financial reporting by several public companies. The law also addressed the failure of several audit firms to fulfill their role as gatekeepers. These events undermined public and market confidence in the financial reporting system of the time. Congress advanced the general principle that strong QC systems are a powerful tool at auditors' disposal and are essential for protecting investors. They ensure consistency in the preparation and issuance of informative, accurate, and independent audit reports. Current QC standards were developed decades ago. The auditing environment has changed significantly since that time, but the standards have lagged far behind. Audit deficiencies reported by board inspectors in recent years suggest that some firms' QC systems are not providing reasonable assurance that its personnel comply with the firm's standards of quality. In 2023, 46% of audit engagements, as was just noted, revealed at least one significant deficiency, compared to 40% in 2022 and 34% in 2021. This is a concerning trend. For several years, the board's advisory groups have generally supported strengthening the QC standard. This past May, the board adopted an integrated risk-based standard, one that sets out quality objectives and key processes for all firms' QC systems. This modernized standard achieves a careful balance between a risk-based approach and standardized requirements. The result is a common baseline that fosters predictability and a level playing field. All board-registered firms are required to design a QC system that complies with the new standard. But the part of the standard requiring an external quality control function applies only to firms that audit more than 100 issuers annually. In 2023, only 14 firms out of a total of more than 1,600 registered firms met this threshold. The EQCF is based on the notion that a second pair of impartial eyes can be helpful when evaluating the significant judgments and conclusions that an audit firm has made with respect to its QC system. This provision has been informed by and evolved from extensive stakeholder input over many years. As required by law, the Commission staff has determined that the board's amendments to an audit firm's system of quality control standards is consistent with Title I of the Sarbanes-Oxley Act and associated rules and regulations. Following its own thorough review of the board's efforts, Commission staff has also determined that the amendment is necessary or appropriate in the public interest or for the protection of investors and is recommending Commission approval. Because the amendments will help audit firms design, implement, and operate more effective QC systems and potentially contribute to improved compliance with professional audit standards, I am pleased to support the staff's recommendation. Thank you.
Thank you, Commissioner Lizarga. Thank you to all of my fellow commissioners. With that, we turn now to vote. I just want to get the proper wording on how do commissioners vote to approve the Quality Control 1000 standard
No.
Yes.
No.
Yes.
Yes. With that, the PCOB standard Quality Control 1000 is approved by a vote of 3-2. That concludes the business of today's agenda. I thank everybody and I thank the listening public.